Sino-U.S. trade wars. We're just going to hold off a little bit longer, just as a few people that want to jump on here. But thank you very much for taking the time to be here, and we should be starting in a few minutes. Thank you. Okay, thanks very much for joining and taking the time. We're gonna do some big picture stuff to kick off with here. A lot of the time when we get the monitor through, we're monitoring the story on a daily basis, and what I want to do here is to really give you guys an overview, so that you can kind of feel that you're moving along with the story, and you're keeping the big picture in mind. So to that effect, I'm going to start just now by giving you a little kind of overview of where we are in terms of the short term, from the US side, just to give us a kind of a couch the picture in something, on the political side. And then we're going to go into the much longer term, and the kind of the big picture, and really to bring in this story that I like to use of China as an excess savings country, and how that is changing, and what are the implications of China's, the redirection of China's excess savings into the Made in China, Made in China 2025, and the Belt and Road, as the kind of the external outlet for those savings, and how those two policies really put China right smack up against the US, and in a sense, the Chinese, well, certainly the Chinese press, state media seems to be seeing the US policy response now as a form of containment of those two programs that they have, Made in China and Belt and Road Initiative. So we're going to delve into that and kind of give you the tectonic plates, so to speak, on that story. And then we're going to wrap up by talking about the immediate threat that we face with China, which is that growth is going to get worse before it gets better, before the official, before the stimulus starts to kick in next year. And what will the authorities do in the meantime? So what's the threat from that? And then I'm going to wrap up by a sort of a longer term upside risk. You'll be pleased to hear, involving if global interest rates get high enough to put pressure on China to actually deal with its problem of bad debt, rather than just kind of shifting things around. So to start off with just the very short-term outlook of the next kind of few months or so, our base case has to be still at this stage that the midterms are a sort of turning point, or at least they're a watershed for the more aggressive stance that Mr. Trump has taken in recent months, both in the sense that hopefully some of his more aggressive rhetoric has been aimed at kind of shoring up the base ahead of the midterms, but also in the potentially that he might face some more kind of bipartisan restraints after the midterms, after we get those election results. The caveat to that, and there always has to be a caveat, of course, in this situation because it is so uncertain, is that the trade deals that are being negotiated now, the replacement of NAFTA, seems to have a distinctly anti-China undercurrent to it, in the sense that it might restrain the likes of Canada and Mexico from engaging in free trade deals with China in future. So if that's now going to be a drift for FTAs between the US and various other countries, Japan would be a notable one within our product. Then this could be another way of sort of cordoning off China as the enemy number one. So that's the kind of the short-term caveat. But as I said, I'd really like to get this into the longer-term picture here and the kind of building the broad brushstrokes out. So when I talk about excess savings, we really start with this chart here. And what I mean is not necessarily just the current account surplus, but any kind of savings that are maintained and sustained above what I would think of as a sort of optimal investment rate, or an investment rate that is sustainable from a domestic standpoint, looking at the demographics, looking at the potential for catch-up growth, moving up the technology frontier, and the investment that requires. And really in China, I would say that this investment, this optimal or kind of sustainable domestic investment rate has been trending down recently because of the changes that we're seeing in demographics. So you simply need less investment if you don't have such a fast rate of population growth. So we have seen some rebalancing here in China that might have halted in 2017. We'll get that data before the end of the year, but there's still a very long way to go here. The savings rate is very, very far above anything that could plausibly be seen as sustainable domestically. So if you have excess savings, then what do you do with them? Well, you can either send them abroad in the form of current account surpluses, or you can send them around internally and invest internally. So just not to bore you, but to make sure we're all kind of talking about the same thing here, I'm quickly going to go through some accounting, and then I'm going to give you an intuition so that we can segue from this into our calls on the renminbi. So we know this is our familiar equation on the macro side of things. The GDP equals consumption plus investment plus government consumption plus net exports, and the current account equals net exports plus some other things which are important, and we shouldn't leave them out when we're thinking about things, but just for the sake of accounting I'm going to leave them out. It's just some extra terms. So we can see there that the net exports can be subbed in, and we get that the current account equals Y minus C minus G minus I. So this G and this C is total consumption in the economy, private and public, and that Y minus consumption is the definition of savings in an economist's way of thinking about things. So then we see that the current account equals savings minus investment. So all well and good, that's the accounting, and we can be satisfied that those things all equal up. But to just give a quick intuition on that, net exports are what you you produce at home, but you can't consume. So given that savings are what you don't consume out of income, then that gives us a kind of an intuitive way of linking this real economy side of things with those financial flows, the savings minus investment, which are capital outflows. So that brings us to the renminbi. Because if your currency is overvalued, it makes it much more difficult for you to export your savings, which has been one way in which China has grown historically. But this chart here shows us in the orange line China's unit labor costs relative to the unit labor costs of its trading partners on a weighted basis, and we see that there's been a huge loss of competitiveness here in the orange line. I'm going to segue back to my little pointer here. So there's been a huge loss of competitiveness there, if I could draw a straight line. We've clawed back some competitiveness in recent years, and this could be a little bit lower for 2018. This is an OECD forecast given the depreciation, the nominal depreciation that we've had recently. But the point here is that we're still facing a situation of I would say overvaluation of the currency, and it's really here that I put the 100 mark for our valuation, and hopefully that will become clear why as I'm going through. So if your currency is overvalued, then you can't export as much. You can't rely on foreigners to plug your domestic demand deficit in the same way as you have been previously. And in 2011, then we start to see here that the 2011-2012, China is no longer grabbing export market share in the way that it was historically. So this is an OECD measure of export performance, which looks at actual growth in exports relative to the growth of the country's export market. So it's a kind of an indicator of how well Chinese exports are doing compared with how well they could be doing given what's happened in its export markets. So we see here that they haven't been doing so well as they were since the WTO entry in this last period since sort of 2012. Now there's a little uptick here in 2017, and remember that, we'll come back to that later. The other way of characterizing this, to go back to our accounting, is don't worry, I'm not going to do more algebra, the current account surplus has fallen very dramatically as a percentage of GDP. And again, there's some nuance on this that we'll come back to later, but I just want to have this chart up there to just show the dramatic decline that we've had. We'll talk a bit more about this and where we might be going further on in the presentation. So if China can't export its surpluses anymore, its financial surpluses, then what does it do with them? Well, it either has to run up internal deficits, but the point there is that if the investments that are being undertaken within China, we've already seen that China's been over-investing for a very long time, so the return on those investments is not as great, and as if they had been sending those investments, those savings abroad. Now, that you put that together with these further two bullet points here, then you end up realizing that if they can't export their excess savings, then there's an element of demand deflation, of disinflation and deflation that we've seen since 2011, 2012. So that 100 mark where I put my for our RMB valuation, which is loose, but it fits in with what we've seen with producer price inflation in China that was in 7% in 2011 and down to negative 2 to 3% in 2012 before the collapse of oil prices. And it also fits in with what we've seen with GDP growth, as we'll see. So here are some more charts for you on the debt side of things. Again, 2011 is back here, so it's when we see the China having to bear the burden of its own excess savings through a run-up in debt, and through more recently a kind of a deleveraging period that has persisted until Q1 of this year. And again, we'll kind of talk about why that might be and how how actually the last 2017 at least was quite a benign period for deleveraging. The period before that, when we saw this big run up in debt to GDP, was here. And we can see really that on our estimates of GDP, it was a rough patch for Chinese GDP, and you can see that not just in our estimates of GDP, which but also in the activity indices. I should mention also that if there are any questions, then please do fire them through, and I'll pick them up at the end. So China's been through a rough patch in 2012 to H1 of 2016. What was different about 2017, and are we going to see that going forwards as well? Well, I think 2017 was different, and it was different in a number of ways. The first way I'd say really was inflation. That's clear that the monetary stimulus that kind of spilled over from the attempt to stabilize the equity market in 2015 and the rebound of global commodities prices, that helped China to get some inflation here in 2017. This is our deflator, not the one that the authorities publish, and that really helps in getting debt ratios down. Compared with this period here, where these black bars, the deflator, are not really helping. Now remember that GDP is on the denominator of our debt ratio, so having inflation is actually very helpful in getting debt ratios down. So 2017 was different in that respect, and it was also different in the respect of so in these green bars up here, if I bore down into these green bars, which are the real GDP growth, these are our estimates of the breakdown between productivity growth, total factor productivity growth, and the contribution from capital, the increase in the capital stock. Labour's not really making any kind of contribution now because the working age population is actually falling, so it can only really rise if there's greater participation. The labour contribution can only be positive with the greater participation. What we're seeing in 2017 is that there was a kind of a rebound here in productivity, but I would call that very much a cyclical rebound rather than a structural rebound. And I don't see anything that's changed in the Chinese economy over 2017 that really convinces me that this is about resources being redirected to the private sector firms, or the firms that are going to be driving productivity growth supposed to be driving productivity growth in the Made in China 2025 program. So I'd say this is a cyclical rebound in productivity, and we'll come back to that point when we get to household debt as well. The point going forwards is actually that that the leading indicators on the monetary side in particular, but also the PMIs are starting to bear out that as well. Growth is trending down. We've seen that probably since late or midway through 2017, that nominal GDP growth has been trending down. On our estimates of real GDP growth, there's a kind of the beginnings of a downtrend as well. And this M1 indicator, which tends to be reasonably good at predicting turning points in Chinese GDP growth, has been pointing down for some time now, and indicates that it has about a 2 or 3 quarter lead, indicates that we won't see an uptick until the first half next year. This is quarter on quarter M1 growth. So we're just starting to see the very beginnings of a teeny weeny uptick right there, but the monetary indicators and some of the other financial indicators also point to an uptick in H1 next year. So does that mean that it's just back to business as usual? If 2017 was a kind of a aberration, was particularly benign conditions for deleveraging? Well, not necessarily, because the drivers of debt appear to have changed. from the corporate sector to the household sector. So in 2015-16, which you see on the x-axis here, the increase in debt to GDP on a sectoral basis, we still have corporations kind of increasing debt a little bit off their own bat, but there's probably also a lot of hidden debt here in the financial sector, which is mislabeled, and some of that is probably attributable to the non-financial corporate sector. I'm thinking about interbank borrowing through financial arms that's actually just non-financial corporate debt. But the main thing that's changed here is the household sector, that in 2016 became a real driver of growth, of debt, of the rise in debt to GDP, more so than the corporate sector, at least on the face of it. And then in 2016 to 2017, which is what you see on the vertical axis here, that the household sector is the only one in the private sector which is above zero, as in they're the only ones that have increased their debt as a percentage of GDP apart from the government sector, which is in the green dot. So this really kind of paints the picture of how it's likely that corporations have probably hit some kind of a wall, and the evidence, at least from Japan, is that once corporations hit that wall, then it's quite hard to convince them to turn around and just kind of start trashing the balance sheet again. So once they've started trying to rebuild the balance sheet as they did, I'd say as far back as 2014 and 2015, which sort of accounts for the slow growth in that period, then it's quite hard to convince them to do otherwise. And certainly if the Fed does continue hiking rates in the way that my colleague Ian, our chief economist, expects, then it's going to get more difficult for these corporations to go out there and start reigniting their debt appetite. It's more likely that they're going to intensify their attempt to repair balance sheets. So that leaves the household sector, and certainly as we've seen interest rates start to kind of pull back and move downwards over the course of 2018, lo and behold, the household debt appetite has reawakened, and we've seen housing starts pick up, and that certainly will be a contributor to 2018 growth in a way that we perhaps hadn't expected, but you can't ever underestimate that rolling ball of money effect. So we have both the decline in interest rates in the first part of this year, and that will feed through to, and probably has already fed through to mortgage rates. And we also have the fact that households have been fleeing the equity market after that rout that we saw earlier in the year, and potentially, well, we've seen some stabilization recently. But money has rolled out of equities and into the housing market, and that has supported construction in that sense as well. So the household sector will be there as a sort of a overheating factor whenever interest rates are low enough, and whenever there's kind of no other alternative in Chinese assets. But really, it's going to be the government that has to step up here and be the one that's willing to expand its deficit in order to facilitate the reduction of corporate deficits, or the rebuilding or the building of corporate financial surpluses. Otherwise, we're just going to see growth being pushed into the ground. It's your old kind of paradox of thrift thing, that if everyone is trying to save at the same time, then nobody really achieves anything other than demand deflation. So probably the government won't quite allow that. They certainly are trying to clamp down on the household side of it, the household borrowing side of it, but they haven't been very effective in that, and that's why we've upgraded the China GDP growth for this year, although we're still very much below what the consensus is. We think growth will probably be around 5.5%, down from above 6% last year, comfortably above 6%, and that's our mid-range estimate. So there's a good margin on either side of that. So it's going to be the government going forwards, though, that has to pick up the slack as corporations continue in their attempt to deleverage. They're not necessarily going to be successful, but they over a long period of time they probably will be. But they certainly will be attempting to repair their balance sheets. So far this year, though, and I think that's part of why we're seeing growth trend. We have seen GDP growth trend down. The local governments have not really been issuing all that much debt or doing all that much infrastructure investment, and that's partly a kind of a deer in headlights effect, which is, there was a very stringent deleveraging, de-risking campaign at the beginning of the year. It was politically very hot. And I think provincial leaders were just sort of, deer in headlights, sit on your hands and don't do anything. What we saw last year was, or what we have seen this year, is that the issuance by local governments has dropped. Now, some of that, I've just drawn these blue lines here just to illustrate that some of the issuance has been to do with the government debt swap program. But even if you take that out, you can see that there's a sharp slowdown in issuance, local government issuance, over the first part of the year in particular. But we now see that the local governments are heeding the call from on high to borrow and invest in infrastructure, bearing in mind that these last few months here, the local government debt swap program is pretty much over. So a lot of this is much more about borrowing for infrastructure investment. And the PBOC has really been supporting that, the Ministry of Finance has been supporting that by advocating or demanding, at least, that local governments use up their quotas by October. So there's a kind of a rush of issuance to get out there and borrow and invest in infrastructure. I said the PBOC has been supporting that. Really, the monetary stance, I would say, began loosening as early as Q2. Again, going back to our M1 indicator, M1 leads growth, but the change in short-term sovereign yields leads reasonably well, leads M1 growth. And we can see that this is advanced by 9 months. And so we can see actually back in Q2, that's when we started to see monetary conditions, or the monetary stance, being loosened. And at the same time, we've had the PBOC attempting and being reasonably successful, actually, in increasing the maturity of the securities and the instruments that are circulating in the interbank market, partly by an expansion of the collateral that has been is accepted in the medium-term lending facility, and also just by injections through the medium-term lending facility. And I think really, so you can see that in this. So this is the net here in the blue. You can see that they've sort of moved towards medium-term lending facility, where the maturity tends to be about 1 year and away from reverse repos, at least for a time in the past few months. And that's helped to calm the interbank market down, such that actually the interbank rates have been snaking along the bottom of the corridor here, and even have dropped below for a time the bottom of the PBOC's corridor. So they've really switched the stance. Of course, there have been reserve requirement ratio cuts as well. They've really switched the stance here, but it's not really going to feed through immediately. Although what we are seeing is that there seems to be a bit of a turnaround, at least in fixed asset investment. These data, as we all know, are kind of shoddy, but these are 3-month averages, so hopefully that gets around some of the problems. And we see the beginnings of a turnaround there after what has been quite a substantial slowdown in infrastructure growth to quite alarmingly low levels. So that's what we see turning around in terms of the real economy. We've seen the monetary policy stance changing. And at this stage, we have to ask, well, is there a new outlet for China's excess savings. And as I kind of alluded to in the introduction, yes, the internal outlet is supposed to be the Made in China 2025, and the external, which I'm not really going to touch on in any detail, is supposed to be the Belt and Road Initiative, which to a certain extent could be used as a way to kind of channel China's excess savings, at least in theory, although there are some roadblocks in the Belt and Road Initiative. And these two policies seem to have put China right up against the US. But does China really have a choice? Do China's leaders really have a choice? They certainly have a choice in terms of how they present these campaigns in the local media, in the state-owned media, and those outlets have been told to kind of tone down the rhetoric on the Made in China campaign. But in terms of what they actually do, the situation with both debt and with pollution sort of mean that they have to redirect those savings into the higher value added goods and to try to move up the value added chain, because the old guard industries are so laden with debt now. As I pointed out, that the corporate sector really is seems to have hit some kind of a wall, and it'll be difficult to turn that around once they've begun their attempt to repair the balance sheet. So the kind of the new growth, quote unquote, new growth industries, the capital has to be redirected to these guys, and it might be a point in the questions for us to highlight what that really means in terms of the long term for China, and whether that really means a pickup in productivity growth somewhere down the line. The second point I want to touch on at this point is the pollution, that the old guard industries, there tends to be a strong correlation between those and pollution, and it's now become apparent that it's politically untenable for the authorities just to continue polluting the environment in the way that they have been over the last more than a decade. So they've again sort of hit a wall there. So in that sense, they might tone down the rhetoric, but they're not going to really change their policy in any way. So far, though, they haven't really been very successful, at least in this most recent round of stimulus measures, to redirect resources to the so-called new growth industries, the downstream firms or the private sector firms that have been starved of resources previously, and incidentally, that probably means they're somewhat more productive than the old guard firms. These data are the profits data, which are hugely, horribly distorted. There's a threshold for inclusion in these data, and you can see here that from 2016 that firms were going above that threshold, and therefore that inflated the profits data, and then from the end of 2017 they were falling below that threshold, and therefore they were falling out of the sample. So I should probably undo that, because it looks like we're anarchists now, but you get the point that the firms are coming in and out of the sample. So it's probably not quite as bad as these data suggest, but certainly if we look at a breakdown between the state-owned firms and the private firms, the state-owned firms have been doing kind of okay recently since the switch in monetary and fiscal stance. But private sector firms are still struggling. So they haven't really been very successful so far in trying to turn around where resources to channel resources to the new sectors so far, and really that's a result of the fact that they haven't quite yet been willing still to allow those old guard firms to fail. It's within any period, it's a kind of a zero-sum game. If resources go to one part of the economy, then they're not going to go to another part of the economy. So to free up resources from one part of the economy, you have to allow them the failing firms to fail. And earlier in the year, it did seem as though the rhetoric at least was turning in favor of allowing allowing failures to fail, and focusing much more on state capital rather than state enterprises. But more recently, we've had more of the talk of state-owned firms are a great thing, and potentially they are in certain ways, but they don't necessarily. They're not necessarily the productivity boosters when they're laden with debt and they face the environmental constraints that we've just highlighted. So what's the near-term downside risk from China? Well, going back to our M1 graph here, growth is going to get worse before it gets better. And as I said, that's borne out by the PMIs so far, and we would expect China to continue losing momentum through the second half. Add to that, we've got the trade, the tariffs, which certainly have shown up in the PMIs, but have yet to be fully reflected in the hard trade data. I think because there's been a lot of stockpiling ahead of when the tariffs were set to be implemented. So that really tells us that a good portion of the hit from the hike in tariffs is actually going to come partially in September, but into Q4, although there could be some more stockpiling given that we've got another expected or threatened hike to 25% from 10% on the 200 billion of goods that we've just seen the initial part of the tariff hike there. So we could see some further stockpiling towards the end of the quarter. So far, that hit from tariffs is reasonably modest, but in the context of growth that is slowing, any kind of a drag is unwanted. Certainly, if we get the hike in January, that's going to start to be a substantial hit to growth. And we've also had Mr. Trump talking about tariffs on all Chinese goods, and that could really start to clock up and be a very unwanted drag. At the moment, we're still kind of at the relatively modest stage, however. So that's a further thing that could come in and dent growth in Q4. And the final point on Q4 is that they've set a precedent. The Chinese authorities have set a precedent by reducing PM 2.5 concentrations and air pollution in major cities last year. So normally, what you get is this spike in pollution in the winter months. And last year, we didn't really see that. We saw a very modest spike. So partly that could be to do with cold fronts and the weather, and it's quite difficult to piece that apart. But the kind of the hard data also shows that there was a weakening of growth, a substantial weakening of production in production growth in Q4 of last year. So it doesn't have to be so damaging in terms of a year-on-year sense this year, because they've already made that pullback last year, but there is the sense in which the authorities are not quite sure whether they were successful last year merely because of the weather, or whether they now need to continue with the stringent production shutdowns. Certainly, the PMIs are reflective of concerns in the business sector that the shutdowns are again going to take a toll on growth in the second half and through the winter period. So then, in that case, the concern is that the authorities then go ahead and do too much if growth is going to be slowing. And the downside risk in that case is that if they do overstimulate the economy in the context of a current account that was in deficit in the first half of the year, and at the same time we've got the interest rate differential very narrow by historical standards, and set to get narrower, given that the PBOC doesn't seem to face any pressure to hike rates at the moment, looking at interbank rates at least. And the Fed seems set to hike in December and to hike another 4 times next year, and potentially to get more aggressive and have to slow the US economy. Then this interest rate differential is well, it's sort of like what interest rate differential at this stage. So the pressure on capital is going to be outward. And if we're talking about overstimulating the economy and potentially pushing a sustained current account deficit at the same time we've got capital outflows, the only way you can really square that is if there's large sales of FX reserves by the authorities, and then you realize that the FX reserves are actually only 24% of GDP, down from above 40% of GDP in 2009, which was the peak. And those things sort of don't really add up, and the only way you can square that is to say that, well, probably it's the capital flows that dominate, and potentially there's scope for further renminbi depreciation in that kind of downside scenario where the authorities do overstimulate. That's not at this stage our base case, because it seems like they are hanging back, and the environmental concerns will provide some form of restraint. We also have a kind of a final point in the authorities' favour with regards to the current account, which is that a huge portion of the deterioration in the current account balance has been driven by this tourism balance, which is Chinese people going abroad and spending, which fits in with our accounting that we were doing previously. It's just Chinese people having greater purchasing power and therefore doing consumption abroad, which is like a form of diminishing that diminishes the current account surplus. But it also means that when the renminbi depreciates, as it has done quite dramatically recently, then it reduces that purchasing power, and hopefully they tighten their purse strings somewhat. So that should help to stabilize at least the current account balance in the meantime. So that was the downside risk. Let's look at the longer term to wrap up here. The longer term downside and upside risk I'll sort of tackle in the same go, because one kind of surefire way of forcing deleveraging is if global interest rates get so high and global liquidity gets high enough to really cause defaults in China and to force the Chinese authorities to actually deal with the situation. And the good news in that sense is that they still seem to just about have room on the government balance sheet to clean up if that happens. Now, the way I address this is to look at the officially what's the space on the government balance sheet. So here we have gross general government debt as a percentage of GDP. I think that's about 44%. And then we have the foreign exchange reserves. So netting out against that, we're at a reasonably low level. Now, of course, there's a whole bunch of debt that isn't counted in that, but you'll see when I undertake this kind of stress test scenario that doesn't matter for these purposes. So a lot of the time when people are worried about debt in China, what they're most worried about is the increase in the level of debt as a percentage of GDP, which we have here, and that includes some of the financial debts, which I think are mislabeled as financial. They should actually be labeled as non-financial. So increase in debt to GDP on a historical cross-country basis tends to be the better predictor of one of the best predictors of systemic banking crisis. So that's what gets people worried in China. Well, let's just say let's take what could be the possible worst. What's the worst that this could possibly be? So let's just take the entirety of the increase in debt to GDP since 2009, as we've done here, and say, well, let's assume all of that is bad. In here, we've got a slight kind of nuance on that, which is that actually broad money has increased over that time as well. So in a sense, that's the money that is available to the corporate sector here, excluding households and government, right here. So if they also have that cash in the corporate sector, then they should be able to deal with paying off some of this debt, and maybe it's not quite so bad as it seems. The problem is that in reality, the debt doesn't tend to be in the same place as the deposits. There are exceptions to that, but in general, it doesn't tend to be in the same place. In China, it's slightly less worrying because the authorities, a lot of that is state-owned, so there is a certain sense in which they can say, okay, well, we'll take money from here and we'll put it over there, and it's somewhat easier in that respect, that they have still some elements of strong elements of command in their economy. The problem is, if they were to do that, there would be a massive contraction of liquidity, and that would drive growth straight into the ground. So it's not really an option just to say, okay, well, let's pay off all of this debt in one go. It's more likely that they'd find themselves taking some of this debt onto the government balance sheet. And I think one way or another, that's what we're going to see in the future, either a kind of a one-off transaction of bad debts onto the government balance sheet, and that would be great for longer-term growth and for EMs and anyone that happens to be riding on China's coattails, because China then has the potential to it's not a sufficient condition, but it's necessary for them to turn onto this path of private consumption-led demand and be a contributor to global consumption demand. So if we do this worst-case scenario here and just whap all of that that increase in private non-financial corporate debt onto the government balance sheet, one-off transaction, and there's a 0% recovery rate, really stressing things out here, then you get to above 100% of GDP. So you're probably raising some eyebrows in the Reinhardt and Rogoff department, but it's sort of manageable. And bearing in mind that this is a super stress test, and also the 0% recovery rate probably isn't very fair, because they do have some financial architecture in place to deal with that. And they have some experience of recovering bad debts at this stage. So this is a super stress test, and also netting out against the foreign exchange reserves, it's not actually, it's high for a country of China's level of development, but it's manageable. So that's the good news, and potentially, if, as I said, if global interest rates get high enough, if liquidity tightens by enough, then we could see them being forced into actually recognizing this situation and dealing with the situation properly, which is a great thing. Would be a great thing for global growth over the medium term. So, summary at this stage. The last few years since, but even before Mr. Trump took office, this period was relatively benign for US-Sino relations, in the sense that China wasn't able to export its savings, and so distortions were built domestically, not in the US. And the US, in a sense, was able to sort of decouple from China because of the overvaluation of the currency. So I think when Mr. Trump took office, it was almost like he was sort of, that was sort of an old story, at least from the perspective of the cycle that we've been in recently. Going forwards, that's less of that's going to be less of a that's less true, in the sense that the current account is now pretty much in balance, and that gives China, pushes China up against the wall and sends them looking for new ways of using up excess savings, and that's where we see Made in China 2020, Belt and Road, and potentially where we see the kind of the climax of this story of further renminbi depreciation and the reopening of the current account surplus, or rebuilding of the current account surplus, which, if that happens around the same time when US growth is trending down, potentially the end of the cycle towards the end of next year and into 2020, then that's when things could start to get more nasty, if that's possible, than they are at the moment. So that's most of what I wanted to say on the big picture there. We've covered a bit of the shorter term threats in terms of growth as well. If there are any questions that we can take at this stage, then please feel free to fire away with those. And if not, then we'll certainly be willing and hopefully able to answer those questions by email, or if you want to get in touch in any other way in coming days. Okay, so we're starting to get a few questions coming in here. I'm just going to read through here. Okay, so how critical is China's consumption growth, and you think, and any trends in personal savings growth that are worth looking at? Okay, so I think 2016 was a sort of a bonanza for the household sector, in the sense of, if we go back to our kind of flow of funds way of thinking about things, that while the corporate sector was trying to repair its balance sheet, that created more savings, in the sense that it amounted to a reduction of the deficit of the corporate sector, or even move into surplus in some cases, and when interest rates were low, as they were in 2016, those savings could sort of easily, or that those financial surpluses could easily find their way into the household sector, in the cases, or parts of the corporate sector that were running surpluses or that were reducing their deficits. So it left more resources to be channeled into the household sector, and the household sector therefore went on a bit of a spending spree. I think some of that was in consumption, and lots of it was borrowing to invest in the housing market. So there was a lot of kind of speculative activity there. In terms of kind of going forwards, certainly in terms of the investment in real estate, the authorities are trying to kind of crack down on that, and kind of place barriers on a city by city basis. It's not going to be that easy, in the sense that they are now loosening on a systemic basis, so they're back to that situation of kind of chasing things around. But in terms of consumption growth, chasing money around different cities. In terms of consumption growth, at this stage, I'd say that the labour market has moved back into deterioration mode. I think we had a kind of a brief reprieve over that H2 2016-2017 period. But more recently, we've started to see some stress in the PMIs, and certainly over that whole period, the PMIs indicated that the manufacturing sector was going through a kind of a productivity drive. I'd say that productivity drive was sort of at the expense of the services sector, which kind of has been acting as a great big sponge for labour that's displaced from the manufacturing sector. But at this stage, the PMIs are just starting to indicate that the services sector is reaching a saturation point in that sense, and that tells me, at least in terms of employment trends, that the household sector is facing challenges. If we then look at the wealth side of this, again, we saw these very elevated confidence indices in that until quite recently, and I think a lot of that was, again, just about the equity market, and certainly that's turned around very sharply over the course of this year. So from the wealth effects perspective, the household sector is not looking so rosy as it has been previously. We have to also factor in the return of that Phoenix housing market, and prices in the housing market are rising. So that's one thing that counts in favour of households and the positive wealth effects that would generate going forwards. A further question here is, okay, this is a good question. Is the conclusion that China devalues further based on the impact from the trade tariffs? So I think what we've seen so far is that trade tariffs were a bit of a catalyst for what needed to happen in the renminbi anyway. I think, excuse me, I think we saw the renminbi sort of appreciating beyond where the authorities were comfortable with after the party congress, and then at the end of 2017. And into 2018, we saw some kind of further appreciation, even though the authorities were kind of dialing back, and we saw some signals there from the PBOC that they were getting uncomfortable with the valuation of the currency. Add to that we've had a current account deficit at the beginning of this year in the first half, and also the kind of so the implications for monetary policy divergence going forwards. I think there's a lot of reasons why even absenting the trade tariffs, we should see depreciation. We should have seen depreciation over the course of this year anyway. So adding in the trade tariffs, certainly China, in the sense of you can win and lose this battle, China is kind of losing the battle in the sense that it's not retaliating to the same extent as Mr. Trump has been imposing tariffs, and in that sense, the currency should depreciate to partially reflect that. So some of the depreciation this year has certainly been already to do with trade tariffs. I think if we get any kind of resolution of that, potentially around the midterms, or if we get any kind of dialing back of the tariff hikes that are threatened for January, then there should be some kind of a relief rally in the renminbi as a result of that. But the story that I've been painting here sort of points to a medium term or a kind of a 18-month outlook for the 18-24-month outlook for the renminbi, in that they really still need depreciation in order to carve out a way of exporting more of their financial surpluses, given that they seem to have hit a kind of a wall in terms of expanding deficits domestically. The one that I didn't really mention was the government deficit, and that's, as I said, the government's set to expand the fiscal, make the fiscal stance yet more expansionary. But the IMF already estimates that on an augmented basis, including some of the local government financing vehicle debt and certain other elements of off-balance sheet activities, in 2017 the government deficit was already 10.6%. So the slides that I presented on local government issuance in the first half of the year should convince you that they at least have some space to expand compared with what they did in H1, but they don't really have a great deal of space to expand the government deficit compared with what they did in 2017. So in terms of running deficits internally to offset the repairing of the corporate balance sheet and the reduction of corporate sector financial deficits moving to surplus, they don't have the space domestically to be able to do that, and it's from that I kind of over a longer term call would be expecting the renminbi to depreciate so that they can export more of their excess savings and rely on external demand to kind of plug the demand deficit. We've got some more questions coming through here. Just hold on, let me. Yeah, how quickly will tax cuts help? Certainly, I think they will help, and certainly in the corporate sector, the business environment, and I should probably have mentioned this, the business environment has become a lot more friendly in certain senses over the past few years, and I think that's helping, and I think tax cuts kind of going forwards will help as well. But then bringing in what I've just said in the answer to the previous question, that the government deficit is already very, very large. So there are some limits on how far they can expand that, particularly when the current account was already in deficit, as you saw in the first half. Just reading a few more questions here. So does China's renminbi depreciation destabilize globally? So I think the reason why we haven't seen the kinds of destabilization from the renminbi depreciation that we've seen over the course of this year, the global reaction, the reaction from global markets certainly wasn't what it was in previous bouts of renminbi depreciation, say 2014, 2015. One thing that's different, we should note, is that the global situation overall has been less deflationary because oil prices have been going in the opposite direction, and that's quite a for the US in particular as well. The relationship between oil prices and the US economy has changed, and it almost behaves more like a Saudi Arabia, in the sense that it should be positive for capex. So we haven't necessarily seen that capex growth coming through yet, but one has to expect that we see a kind of a reworking of the capex dent, the hit to capex that was brought about by the decline in oil prices. That works in reverse. So the global economy over the course of this year and since oil prices started rising halfway through last year has been in a less deflationary state. So if you add renminbi depreciation to that environment, it's less destabilizing than it was back in 2014, 2015. But to add to that, it's less destabilizing because the depreciation was sort of just undoing the unwanted appreciation that we'd seen over the course of 2017 and into the beginning of 2018. So we really were just kind of getting back to previous lines in the sand. I think if we were to see depreciation from here, then sharp depreciation, at least from here, then it would be more threatening to global markets, particularly if we were to see that sort of going into next, or the sort of in the latter part of next year, because that's when global growth, US growth, is set to be slowing, and European growth potentially slowing even before then. One point that kind of reminds me of, just while we're still talking, is that the difference in this cycle from previous cycles is that the distortions from Chinese excess savings have been built up within China, as opposed to in previous cycles where the distortions or the kind of the effects of Chinese financial surpluses, while they could still export them abroad and put downward pressure on global interest rates, those distortions were built up predominantly in the US economy. So this time around, when the Fed is hiking, the Fed can hike beyond where you might expect, given previous cycles and the relationship between the US and the rest of the world, because it's China that's going to be slowing as a result of Fed hikes. We could get into a discussion of how exactly that happens, but I don't want to take up too much of your time. We also have some other questions here. So do you not think that China is switching from being a manufacturing intensive and exporting economy to a consumption and service economy? So I think since the financial crisis, or so let's say before the financial crisis, that was clearly a time when they were very, very export dependent. They could export a lot of their surpluses, their financial surpluses. They had a huge current account surplus that was about 10% of GDP. After the financial crisis, what we saw was that China had to use its own. There wasn't an external borrower in the same way as there had been with US households to offset Chinese demand deficits. And as a result of that, what we saw was the authorities getting in and doing a lot of investment, and that closed down the current account surplus, and that was part of how China began to bear the burden of its excess savings domestically. But a lot of that investment was done was unsustainable, as I pointed out in that chart with the kind of maximum optimal investment rate being about 35% investment as a percentage of GDP. So I think there is certainly there has been already a shift away from export dependency towards domestic investment dependency. I think going forwards we might see China becoming a bit more export dependent again. In terms of the shift to consumption and service economy, yeah, certainly that's happening. But the point at this stage is that, is it happening by default just because the rest of the economy is weaker, is growing at slower rates than it has been historically, or is it happening because the household sector is sort of leaping forwards and growing sort of off its own bat? And I think it has to be, so far, it has to be, apart from the 2016 to 2017 period, it has to be said that private consumption has been leading sort of by default. And if we go back to that chart with the, is it possible maybe that we end up in a situation like a kind of a Korea type of a trajectory for growth, where the efforts to repair corporate sector balance sheets end up with households reducing their financial surpluses and doing a lot of borrowing to consume if their labor income is not quite sufficient. I think that is possible. I think that's what we've seen previously. But the kind of the upshot of that, if we go back to the slide that we had on productivity, is that the type of investment that is undertaken by this sector, or the channels that it ends up going into, is the housing sector and housing investment, which doesn't tend to be a particularly productive form of investment. We can see that also from the US cycle prior to this one, before the subprime crisis. That was quite a low productivity growth cycle, and it was the household sector that was in the driving seat there. It was household borrowing and housing that was in the driving seat there, and that kind of gives us a good example of low productivity growth that can be engendered by that type of investment. And Korea would sort of give us the same answer to that. So going back to our idea of kind of deleveraging and whether China is undertaking a kind of a benign transition to private consumption-led demand rather than just private consumption by default, you need productivity growth if you're gonna find a way of reducing debt ratios on a total economy basis. That's the lesson that we get from Korea, also from Japan. And to an extent in the case of the previous cycle in the US. I think that's the questions that we have time for, that we have just now. So I thank you all very much for having taken the time to listen and to join in today. Any other questions, please get in touch with us, and enjoy the rest of your day. Thank you.